Hello, welcome to my channel. Today we're going to talk about something I think is really important, but it's going to be really unscripted. So I don't know how this video is going to turn out, but just like and subscribe. Please just like, okay? It helps a lot. So just please like. All right. So today I'm going to talk about the stock market. I'm not going to tell you how to make fantastic returns or anything like that, but I'm just going to tell you some of the things I've learned and observed from my first year of investing. And I think the first thing to know is you might be riding a wave. So I might be, all the insane returns I've gotten so far, I don't think it's because I've invested fantastically. It's just what's just happened is that the stock market in general has just gone up crazily. Okay, so so what I'm trying to say is that don't be overconfident. Don't think you can just keep pouring money into the stock market and keep generating returns. Even though it seems like that at the moment, you do not want to be riding a wave, because I'm telling you, people upstairs driving this wave, pushing this wave, are going to go out right before there's going to be a collapse. Okay, I'm not saying there's going to be a collapse, but I'm just saying don't be overconfident. Okay, most likely you're not a fantastic stockbroker, so you might be riding a wave with all your investments just going up. That's just a word of advice. My second point is don't time the market. So what I'm saying is that don't be holding your money and say today I'm not investing, tomorrow I'm investing, today I'm not investing. What is going to end up happening is that you're going to miss out on great investing days. Okay, the reason why
is that nobody can actually tell what will happen in the stock market.
every year the stock market is going to crash, or tomorrow the stock market is going to go up. From experts, nobody knows what will happen in the stock market. I've seen days where it has gone up wildly and nothing has changed. If I check the news, nothing has changed. So don't try and time the market, because you're going to end up missing on great return days. Nobody knows what will happen. So you thinking that you have a strategy around actually timing the market, especially for, I think my audience is going to be beginner investors, don't even think about it. The best thing to do is just continuously put money that you can afford into the stock market and let time the market do its thing. Let your money compound over itself, and you will be better in the long run for doing that. You have highs and lows, but generally the stock market goes up in many cases. Okay, so it's better to just spend time in the market than actually timing the market. There's a lot of things all these investors say, but it's the truth. It's the truth. Nobody actually knows what will actually happen in the stock market tomorrow. The next thing is trading is not investing. More specifically, day trading is not investing. Because the way I see it, investing is all about putting your money into good businesses. So if I put my money into a restaurant in the street, for example, I'm not going to keep buying and selling it every day. But that's basically what day trading is. You keep buying and selling based on different metrics and all this kind of complicated stuff. And I don't think that's actually investing. Okay, investing is you put your money into something you have faith in through research, and then you hope to grow as the business grows. You put your money, the stocks are at the end of the day part of the business, ownership of a business. So you just don't want to keep buying and selling, and it's very different from trading. I'm not trying to knock on day trading, but that's exactly what a lot of these people on YouTube, especially I get a lot of these different ads. I think it's because of the stuff I watch, but I get all of these different ads telling you can make 10x, 5x, 7x, 100x. What these guys are saying is probably a lie. It's probably a lie, but those kind of returns could only be possibly seen through day trading, and that is a little bit more sexier to do day trading. But I think day trading is extremely hard, and that's not something we're going to get into in this channel. And it's extremely hard. It takes a lot of diligence. It takes a lot of risk, and there is a lot of people lying to you on YouTube about it. Okay, so day trading is really, really hard, and it's not investing. The next thing is that story stocks. These are stocks I think, that have popularity in the general public. So for example, DoorDash. DoorDash just went public, which means we can actually buy its stocks in the public stock market. But what people don't tell you is that this story stocks, they usually have way too much hype, which means the value is way higher than it's supposed to be in a lot of cases. So story stocks are not always the best to put your money into. A lot of them are usually tech stocks because people don't really have a good understanding of tech. So when we hear that there's going to be a new understanding, we automatically think, oh, this could be the next Microsoft, the next Apple, the next Amazon or something. So the hype in them drives popularity, and people just keep that money, putting that money inside, which artificially raises the value. And we've seen, especially in 2001 during the dot-com boom, that only some of these companies will end up making it because the fundamentals that are supposed to drive decisions are not used to make these investing decisions in these story stocks. I'm not saying DoorDash is a story stock. All I'm saying is that if a company just recently came in the public and we can buy it now, there's usually a lot of hype behind it and a lot of press and stuff like that, which drives up demand for the business, which might be risky. So you just want to be aware of story stocks, and exactly stocks that are very popular, like Uber, like the company is very popular. When you actually check its financial statements, it's not good. It's burning money. Its cash flow statement is terrible, but we all know the company. So people that are just new into, especially beginners, would think, oh, Uber, everybody uses it. I might as well put my money inside. But Uber is not profitable. So you should be aware of story stocks. The next thing I have to say is past returns do not guarantee future returns. So what am I trying to say here? Just because I made 100x of my money, for example, it doesn't mean you will end up making that amount of money if you put your money now, because basically put your money at different times, and things can always change in the market. As I said, we never know what will happen in the market, but generally the stock tends to go up if there's good news about the market, because the stock market is all about expectations, and if you meet the expectations, people are putting money for future returns. So for example, I put my money into Stitch Fix when the price was extremely low, and the price now, it was at $18 my average cost, and it went up to $70 at one point. So if I kept buying it, and I expecting the same return, it wouldn't happen. So because the same return from $18 to $40 is not going to be the same from $40 to $50. It's not the same return. Okay, so because I'm putting my money, if you put your money at a different time than mine, you will not get the same returns. You possibly will not get the same returns. So past returns do not guarantee future returns, because we do not know what will happen in the stock market, and the opportunity may have already passed. Okay, so you need to be aware of when somebody tells you, I made 100 times my money in this stock. But it doesn't mean that's going to happen for you, even if the company stays the same, because you're investing at two different times. And then the last thing is that ETFs, which are basically stocks that mimic index funds, basically they combine a lot of businesses, so which means they diversify in a lot of businesses, and basically divvy up a stock to mimic all the stocks combined together. So instead of putting your money into Apple, you basically put your money into Apple, Amazon, that's a Tesla, Walmart, something like that. It's a combination of all these companies chopped up into one single stock. And they're generally safer because you're diversifying, so your risk is split between many different companies. And these ETFs are generally managed by people that should know what they're doing. So when you put your money into the stock market and you put it into these ETFs, you're basically giving your money to a manager to actively or passively, make a portfolio for you. So the person's decisions are going to drive the returns for you, and you're basically putting your money into somebody that should know what they're doing. Especially for beginners, it's very important to know that you don't only have to buy individual stocks, Uber or something. You can buy a combination of all the stocks and diversify your risk and get a possibly safer return. So that's basically everything I've seen from the stock market. Just different things I think small investors should be aware of. So people that don't have gazillions of money but are just getting started and just getting that fit with the stock market, I think these are certain things you have to know. So you might be riding a wave. Do not time the market. Trading is not investing. Story stocks, new popular stocks are not always the best place to put your money into. Past returns do not guarantee future returns, and ETFs are generally safer because they're diversified and give your money to somebody that should know what they're doing. Thank you. Like and subscribe again. Please just like and subscribe. If you like this video, like and subscribe. Please comment. I need to know what you guys think. See you later.